In this lesson, we will explore the two primary methods of tracking inventory, the perpetual inventory system and the periodic inventory system. Both play an essential role in how businesses monitor stock levels, record transactions, and manage financial accuracy. Understanding the differences between these systems helps organizations choose the right method for their operations, efficiency goals, and technological capabilities. Let's start with the perpetual inventory system. In a perpetual system, inventory records are updated continuously in real time. Every time a product is purchased, sold, or returned, the system automatically adjusts inventory quantities and values. This approach provides up-to-date information on stock levels, making it easier for businesses to make informed decisions about reordering, sales, and production. Perpetual systems rely heavily on technology such as barcode scanners, RFID tags, and integrated point-of-sale systems. For example, when an item is sold at a retail checkout, the system immediately reduces the on-hand quantity in the database. Likewise, when new stock arrives, it is scanned into the system, updating the records instantly. This level of accuracy helps reduce errors, prevent stockouts, and improve customer satisfaction. The advantages of a perpetual inventory system are significant. It provides real-time visibility of inventory across multiple locations, supports automated reorder alerts, and enhances financial reporting accuracy. Managers can quickly identify discrepancies, monitor slow-moving items, and make data-driven decisions to optimize stock levels. However, implementing a perpetual system requires an upfront investment in technology and training. It also demands reliable data entry and system integration to function properly. Now let's look at the periodic inventory system. Unlike the perpetual method, a periodic system updates inventory records at specific intervals, weekly, monthly, quarterly, or annually, instead of in real time. Physical counts are conducted to determine the actual quantity of inventory on hand, and adjustments are made to reflect changes due to sales, purchases, or losses. In a periodic system, the cost of goods sold, COGS, is calculated at the end of the period using the formula beginning inventory plus purchases minus ending inventory. This method is simpler and less expensive to implement because it doesn't require continuous monitoring or advanced software. It is often used by small businesses, startups, or companies with limited resources. However, the periodic system has its drawbacks. Since updates occur infrequently, managers have limited visibility into current stock levels between counts. This can lead to overstocking, stockouts, or undetected discrepancies such as theft or damage. Decision-making is also slower because information about inventory changes is only available after the counting period. Choosing between perpetual and periodic inventory systems depends on the nature of the business. Companies with high sales volumes, multiple product lines, or fast-moving goods often benefit from a perpetual system due to its real-time tracking and accuracy. Meanwhile, businesses with low transaction volumes, stable demand, or limited budgets may prefer the simplicity of a periodic system. Some organizations even combine both methods, using perpetual systems for high-value or critical items and periodic counts for low-value goods. Technology has blurred the lines between these two approaches. Cloud-based inventory management platforms now make perpetual tracking affordable even for small businesses. Mobile apps and integrated accounting systems have simplified data entry, allowing real-time visibility without heavy infrastructure costs. In summary, the perpetual inventory system offers precision, speed, and efficiency, ideal for modern data-driven operations. The periodic inventory system provides simplicity and lower costs, making it suitable for smaller or less dynamic environments. The right choice depends on a company's scale, industry, and technological readiness. By understanding both systems, businesses can implement the approach that best supports their operational goals, ensuring accurate records, financial integrity, and effective inventory control.